I think both of those things are true, but remember that the where we're going in terms of the short term, the short end of the Treasury market is really determining the funding costs in terms of what's going on at the long end too. So, I mean, I think that one of the big themes over the course of 2023 has been the term premium, so how steep the curve should be. And we've seen a big shift in terms of the term premium going up, particularly in the second half of the year. And I think that's going to continue. With all the issuance we have, we're probably going to see a continued steepening in terms of the curve. And the reality is, of all the things that Jerome Powell is saying, probably the Fed is not going to be the focus next year. It's going to be much more about, as you said, supply, about how the US economy is doing. And whether the Fed is forced to actually change track in the second half of next year. So there's going to be much more of a disconnect between the front end of the curve and the long end of the curve next year.
All of them are fascinating, Guy. What about what's going on elsewhere that's not in the control of the Fed as well, or in control of the Treasury for that matter as well? There is a thought process going around in your world that actually if the Japanese really meaningfully are going to just let go of yield curve control, we don't actually have a full yield curve control exact ceiling anymore, if we take the Japanese at their word as well, then is any of that money that people are worried about going back home to Japan from other places, is that going to create a problem as well?
Well, I don't know if it's going to create a problem per se. I mean, most of the real focus in terms of the Treasury market has been domestic purchases over the course of the last 3 to 6 months. So I think it's probably much more than Asian flow within the Treasury market. It's much more whether domestic people see that there's value in terms of the market at the moment. A lot of people think about yields relative to where they've been over the past couple of years. I mean, we all, I think naturally we look at the yields, we say, well, they're relatively high compared to what I could get in 2020, 2021. So I think it's like a lot of markets at the moment, it's much more domestically driven than what's going on in terms of Asian purchases for treasuries per se.
Guy, good morning to you. I'm going to jump straight into those corporates then as well. And there's this really great graph in one of your notes that really speaks to the amount of cash that some of these corporates were hoarding, specifically during the pandemic. As you can see, that spike really happening in that pandemic time, trying to hoard as much cash as possible. What actually happened to all of that cash? I mean, surely it hasn't all just been used to kind of survive this higher inflation and higher rates market, has it?
Well, I think two things have happened. One is a lot of the profits of corporates, particularly over the past 12 months, have been flattered by the fact that corporates have put it to work in deposit markets. So they borrowed a lot at low levels. They put it out recently at higher levels. So a lot of corporates worked a little bit like a bank or like an investor in gaining the gap between what they were getting on short-term money and the level that they paid for that money back in 2020, 2021. But because a lot of the money that they borrowed in 2020 was relatively short-term, they have had to pay some of it back, and they will continue to have to pay some of it back in the quarters, in the years to come. So I think the reality is that the borrowings that we saw, which had helped them both in terms of their overall funding costs, but also in terms of their profits, will have to be paid back in the quarters to come. So I think the clear answer is why the liquidity ratios today don't look as good as they did a couple of quarters ago is because some of the money's been actually paid back.